Hi, today we are going to be talking about three of the greatest recessions that happened in the last 100 years: the Great Depression, global financial crisis, and COVID 19. We're going to be talking about the causes and how the UK and the US have managed to recover from these recessions and what policies they have used to combat these major recessions. The Great Depression. Up until 1929, the US had experienced great economic growth, but the Wall Street crash happened in October 1929, which was a large, sharp fall in share prices on the New York Stock Exchange, where share prices dropped by around 40%. The Wall Street crash caused a great lack of business and consumer confidence, and shareholders lost money in the crash, and firms cut back on investment, which reduced aggregate demand in the economy. The banking system is also to blame. The banking system could not cope up with the bad debts and lack of confidence following the Wall Street crash. And in the 1920s, they were being allowed to lend too much money to consumers, which created an unsustainable credit boom. And loans to businesses and consumers fell sharply, which reduced AD in the economy. Protectionism was another cause because of the Smoot-Hawley Tariff Act, which raised tariffs on imported goods, which essentially reduced imports to the US. And since imports to the US were another country's exports, other countries produced tit-for-tat responses, and by raising their own tariffs, which created trade wars, and there was a shrinking of world trade within the economies. Since the US and the UK were both export led, the shrinking of world trade caused a lack of consumer and business confidence, and there was a bank failures because these industries could not pay back their loans. In the UK, the gold standard issues were a contributing factor in the initial slump. In 1914, the country left the gold standard. The gold standard is where the pound was fixed against the price of gold, and this meant that its exchange rate was fixed with other countries. Because it had abandoned this in 1914, there was a fall in the value of pound, and it went back in 1925, and this meant there was a sharp appreciation in the value of the pound. Exports became more expensive to foreigners, and so they fell, and firms had increased costs, so they had to reduce their costs by cutting the wages of their employees, and so caused general strike of 1926. Both the US and the UK believed that a balanced budget was the key to recovery, and so in 1931 the British government introduced an emergency budget which cut public sector wages and unemployment benefit by 10%, while income tax was raised from 22.5% to 25%. This deflationary budget reduced aggregate demand when aggregate demand needed to increase, and so the recovery was delayed. The Bank of England needed to defend the value of the pound through the gold standard, and because the value of the pound became under speculation, because they believed that the Britain would be forced out of the gold standard. They believed that, the Bank of England believed that if the government budget was balanced, it would help to prop up the high exchange rate because they would not have to borrow from abroad. They also increased high interest rates to defend the exchange rate, but it had a negative effect on the recession. But in 1931, the government was forced to take the country out of the gold standard, and so the value of the pound fell by 25%, and interest rates were cut to 2.5%, and which increased domestic borrowing, while the fall in the exchange rate increased exports. Recovery in the UK was strong and rapid, and especially in London and the southeast because there was a house building boom, but it was slower in the northern regions, in Wales and Scotland as well, because unemployment was persistent here, because there was little recovery in the shipbuilding, steel and coal industries. However, in 1941, there was full employment return in these regions because of the Second World War, and that was because of the great increase in government spending in these regions, and so it can be seen that fiscal expansion can get an economy out of recession and into full employment. In the US, depression reached its worst in 1932 to 1933, and therefore a new president was elected, Franklin D. Roosevelt, who promised a New Deal. This was a fiscal stimulus package which promised public sector investment and work schemes for the unemployed. As in the UK, it took the Second World War to get the economy back to uh, full employment. The USA entered the war 2 years later in 1943, and so full employment in the US was reached 2 years later. Uh, um, and so the UK made a quicker recovery than the US.
The global financial crisis. The financial crisis occurred because banks were able to create too much money in too short of a period, which was then used to push up house prices. Before the crash, there was a boom in economic demand. There were risky bank loans and mortgages handed out to people with poor credit history. This means after house prices crashed in the US in 2006, several homeowners defaulted on their mortgages in 2007. Every time a bank makes a loan, new money is created in the leading up to the crash. Banks had made so much money that they had doubled the amount of money in the economy, thus subsequently doubling the debt in the economy. This money was then used to push up house prices. The new money that was created was spent mostly on residential property, which, as said before, pushed up house prices faster than wages. This meant that the mortgage payments that were due were not being able to be paid by the people because interest must be paid on all loans that banks make, and with the debt rising quicker than income, eventually some people became unable to keep up with the repayment. At this point, they stopped repaying their loans, and banks found themselves in danger of going bankrupt. This process was what primarily caused the financial crisis, as straight after, banks limited their new lending to businesses and households. The slowdown in lending caused prices in these markets to drop, and this means that those that have borrowed too much to speculate on rising prices had to sell their assets to repay their loans. House prices dropped and the bubbles burst. As a result, banks panicked and cut lending even further, and a downward spiral thus began, and the economy tips into recession. The US's response to the global financial crisis. The response to the global financial crisis of 2008 was different. The classical view that unemployment would be cured by the labor market self-adjusting to a balanced real wage had been challenged by John Maynard Keynes. Keynesians argued that governments need to spend more money in the economy to stimulate recovery, and most countries had stimulus packages in place within 5 months of the collapse of Lehman Brothers in September 2008. In the US, President Barack Obama in 2009 signed the American Recovery and Reinvestment Act, a stimulus plan that was worth almost 6% of that year's GDP. Although elements of the stimulus will reach to 2019, more than 90% of the budgetary impact was realized by the end of 2011. The stimulus was mixed between tax cuts for businesses and spending on health, education, social security, and infrastructure. In sum, the US government pursued an expansionary fiscal policy during the Great Recession. Monetary policy. In the US, at the end of October 2014, the Federal Reserve announced the end of its quantitative easing program, which has spent 4.5 trillion US dollars. The objective of quantitative easing was to help businesses have access to finance at a time when the supply of credit in the market had been scarce. The effect of QE was to lower long-term borrowing costs for firms and individuals, which should then have stimulated spending. In the UK, a number of fiscal measures were introduced which amounted to 2.2% of 2009's GDP. These included a reduction in VAT, support for the construction sector, spending on infrastructure for schools, hospitals and green energy, and training help for the unemployed. However, by 2010, the UK had moved towards measures aimed at reducing the budget deficit, in contrast to the US where this was considered less a priority. The UK government used expansionary fiscal policy shortly after the financial crisis. VAT was cut from 17.5% to 15% in an attempt to increase consumer spending. The government received less tax revenue due to the recession, which led to an increase in government borrowing. In the UK, the Bank of England MPC cut the base interest rate in stages from 5.75% in 2007 to eventually 0.5% in March 2009. In the US, the Federal Reserve cut the interest rate in stages from 5.25% in 2007 to 0.25% in 2008. Both countries cut interest rates to stimulate aggregate demand. Once the interest rates set by the MPC and the Federal Reserve had reached record lows, there was no scope for further reductions. To further stimulate the economy, a different monetary tool was used. Since the global financial crisis, both the Bank of England and Federal Reserve have used the policy of quantitative easing, as said before, to try and revive consumer spending and economic growth. During the credit crunch of 2008 and 2009, the Bank of England used quantitative easing as part of monetary policy. This involved creating money electronically to buy assets such as government bonds from banks, and this was also used to keep demand and inflation at a stable level. Both had very different responses to the global financial crisis. However, many thought the UK response was better than the US response, and many countries followed in their footsteps. The UK weakness was that after the crash, the economic growth that followed after was much slower than ever before, and the US recovery was faster. The US approach was to give money to lower income citizens in the US, and both countries, learning from the US's previous mistakes of letting the Lehman Brothers collapse, helped banks by bailing them out. The US pursued a less stricter fiscal policy than the UK. Barack Obama wanted to continue a high fiscal stimulus, however, was forced not to, while in the UK the decision was made to cut the fiscal deficit.
COVID-19. The main cause was the lockdown measures taken place by the UK and the US, which reduced the amount of non-essential shops being open. This meant that they had suffered huge losses and some even went to bankruptcy. It reduced business activity in the economies, and hence consumption and investment reduced, which caused a great recession. The economy of Great Britain had shrunk by 20.4% in just the second quarter of 2020, which shows how much the lockdown had affected business activity and economic growth. The UK had responded to this by reducing interest rates to 0.1% and increased quantitative easing by 200 billion, which increases domestic borrowing as a whole and stimulates aggregate demand because consumption and investment directly increases. Expansionary fiscal policy was also used by Rishi Sunak, as 100 billion pounds has been pumped into the economy to recover from the coronavirus recession, and the job retention scheme was used to reduce unemployment in the economy, and this was in contrast to the approach used in the Great Depression, where the British government used the emergency budget in 1931, which cut public sector wages and unemployment benefits, which was deflationary and had a prolonged effect on the depression because it increased the recovery time, whereas the approach used by Rishi Sunak is the complete opposite. It's expansionary and has a positive effect on the recession because it stimulates aggregate demand in the economy.
The US's COVID response. The American Rescue Plan was signed, which provided $1,844 billion, which is about 8.8% of the US's GDP, in order to relieve some of the pressure created by COVID-19. This direct stimulus of payments is hoping to extend the unemployment benefit program and add funding to school, as well as increasing resources for vaccination programs. This expansionary fiscal policy used also included a one-time tax rebate for individuals. On the 28th of December, President Trump signed the Coronavirus Relief and Government Funding Bill as part of the Consolidated Appropriations Act of 2021, which was worth $868 billion, about 4.1% of the GDP. The act included enhanced unemployment benefits of $300 weekly, federal enhancements and benefits through March 14th, direct stimulus payments of $600 to individuals, resources for vaccines, testing and tracing, and funding for K-12 education. The US continued to use money to help funding. The US lowered interest rates in order to help the economy. This expansionary monetary policy was used to help small businesses and individuals. The Fed went beyond what they did in the 2008 financial crisis and initiated a plan designed to provide backstop funding to a wide variety of markets. So comparing the response that the UK had to the US, the UK had increased quantitative easing, extended government-backed loans, and extended the job retention scheme. This was all to help the economy as it provided a cushion in response to the economic fallout due to the stricter COVID-19 rules. The government also subsidized loans in order to stimulate more demand in the economy, and the overall response has been far better than most countries. While in the US, the support from the government was unclear, and Congress and the White House were unable to agree on a second fiscal stimulus package. The US's response was lackluster in the context of the financial stimulus package, and they failed to mitigate the economic fallout from the second wave, while the UK's fast response did a far better job of damage control. And in the end, the UK's response was much better than the US's.
That's all, folks.